The topic today is financial clarity for construction businesses. I might just intro our other guests today. We're very privileged to have two of our partners from our advisory team in the webinar today. So Dan Wilkinson, who has been with us for 5 years now, Dan.
Just shy. Yep,
Yeah, I'm
correct.
going to say five, mate. It
Yeah.
feels like five. Um,
Yes.
so Dan heads up our advisory team, has a strong background in, yes, Dan the man, as Jordan's calling you. Um, had strong commercial finance background. So worked in, large businesses in sort of roles, CFO, FC style roles, finance manager roles. So has seen a lot of stuff when it comes to the finance function and how it needs to operate at scale. So thanks for coming along, Dan.
Pleasure. Pleasure.
And Dave Holsgrove is our newest partner in the firm. So Dave, for his sins, spent 10 years or so at KPMG at the beginning of his career. So has sort of seen that sort of big four consulting side of the world. Had then went out into various commercial roles, as well as running his own business that he built up and exited very well. So we now have talked him into coming and working at Xact, which he's been doing for the last 18 months or so, Dave.
Yeah, not quite, but it's getting close.
Yeah,
Correct.
is it me just exaggerating all the time? But yes.
You're head of marketing. That's what we expect from you, Phil.
So yeah, Dave's been with us for around 18 months, and but Dan and Dave both have a portfolio of clients. So the content that we're working through today is going to be based on the work that they do day in, day out, helping businesses like you guys who are on the call today get better financial clarity in their world. Financial clarity. When people turn up, to start talking to us about, the pain points that they have around financial clarity, they usually are on a journey with it, and they usually will fit into one of these three different buckets. Unfortunately, some people come to us and they are in survival mode, so they can't see anything in the business. It's starting to cause major issues for them. And, as we'll see in a poll in a minute, they just will not even see the bus coming if it was heading their way from a financial perspective. Hopefully, not many of you people here today are in that category, but I'm sure probably some are, and it's okay. It's good that you're here. We're going to try and cover off on some of the solutions. Stabilizing, I reckon this is where most of the people will be who have leaned into something like this webinar. So you're starting to get better systems and processes in place, trying to get all of your platforms talking to each other, trying to get the right processes in play across the business. And you're starting to get to this sense of really starting to stabilize what's going on across the business in the finance function. Ultimately, we want to get you guys to full control. This is where you've got a well-oiled machine when it comes to your finance function. You're making very well-informed decisions, and you really can see what is coming. Whether it's an ATO bus, a supplier bus, whatever the case might be, you've got it clocked. You know exactly what's going on, and you can plan around it and plan for it. So that's where we sort of usually see people come into our orbit. In terms of the structure of the content today, we're going to start with the transactional side of things. So Dave is going to talk us through what are the key processes that we need to have at a transactional level, so data coming into the business, and what are the platforms that we need to be considering. Why do we have a Build Xact or a Wonder Build versus why do we have a Xero? And then also what does reporting look like as well? Dan is then going to talk us through the month-end close. This is a mission-critical process that you do need to have in place if you want to get financial clarity. People are doing sort of a version of this on the back of the beer coaster, often a bit DIY. Dan is going to go and show us today what gold standard looks like in terms of month-end close, and it does include WIP. So we're going to talk that through at a high level. Then we're going to talk about the reporting pack that you want to be looking at every month. This is the numbers, this is the reports, this is the data that I'm looking month in, month out, and what the review process looks like. And then finally, we're going to talk through budgeting and forecasting. Now, that is included in our reporting pack, but we need to talk about it as a separate piece altogether because it is so critical. We don't want to just see past performance. We want to see what's coming down the road. Finally, the final section, and it's a foundational layer as well, is how do you resource your finance team? How do you resource your finance function? And what are the options that you've got available to you there? Let's get going. So, Dave, I think we might talk to you first about the transactional side of things. So this is, I guess, the front end engine room of financial clarity, and this idea of trying to get good, clean, timely data into the business. So we might start. There's two slides here. We've got a slide on the workflow piece, and then we've got a slide on the different platforms. Maybe we start with the workflow side of things, and what a good workflow needs to look like in terms of getting good transactional data into the business.
Yeah, absolutely. So like if we think about what the end goal is to get accurate job costing and to get accurate financial reports at the end of the month, end of the period, end of the year. To do that, we have to have really clean data capture and data in. Now that starts with the purchase order. That should be issued before any works are done, so you can lock in your price and your terms. Then when those receipts start coming in, we want to use a system like a Dext or something like that to capture that and code it. And you want to all code it to your job codes, not just in a big bucket of unallocated costs that you can't track and you can't understand, and you got to unpick it. And these things are all with the right data stack, these things are all automatically done. So it's not like it's going to be a big heavy lift or burden. It actually is quite clever, what they've done now. Cost matching is really, really important because without this, you can't get that clarity. You need to take every cost and allocate it to a job. Or if it's an overhead, it obviously goes in the overheads bucket, but primarily we need to capture every single cost to a job. And then likewise with labor, and this is one of the most critical things that Dan and I see with our client base is people not allocating their labor correctly to jobs. They just leave it in a big bucket, and then you don't know if you're winning or losing on your jobs. So that is a really critical focus. If you don't do that, you really should start doing that from now on, is capturing that time. And then when do you do it? This should be done ongoing, weekly. We don't want to do it once a month, once a quarter, and then have this big lump of work to do. We want to get in and just knock it off, every time a couple of times a week, just knock it off. So it's not a big task, because otherwise it gets out of control, becomes scary, and people just avoid doing it. So that's
just picking up on your timesheet allocation. That is one that regularly we see confusion about, particularly things like, oh well, I'm an owner, but I'm still swinging the hammer, or those kind of wages, and knowing how to allocate those. What have you got? I guess some pointers in terms of like just some golden rules around labor allocation and where it might sit.
Yeah, so in a very simple rule, anyone who touches a job or works on a job, like physically, then they should be allocated to a job. Depending on how your business is structured, like an estimator or something like that can be a bit, 50-50, depending on what your business structure is. Your person doing your accounts would sit as an overhead, for example. But anyone who's physically on site, directing site, having those client engagements, they really should be allocated to a cost, because that's the cost to produce the job. And so that's probably the simplest way to break it down, is if you're on the job, you get costed to the job.
And if we're allocating labor costs, which clearly is a material component of the business model of construction, we've got a lot of money going out the door in wages, then we do need to try and capture all the components of those wages against the job, so we can see ultimately, as you say, job costing, back costing, whatever you want to call it. That's the ultimate goal here in terms of why we've got this data being matched up to the job. But if we're not capturing all those aspects of labor, you really, you're not properly getting a measurement of what your margins look like for that particular job.
Correct. Phil, just one point on that.
rhythm.
One point on that. I think Dan and I can both attest to that. Most of our clients are really good at capturing materials and estimating costs and cubic meters and that. But labor is where we win and lose. That is the number one thing. So that's why this timesheet thing, you'll hear Dan and I and our team bang on about it all day. You have to get this part right, because that's where you'll win. That's where everyone wins and loses in construction. Underestimate the labor. It costs more than you thought. So yeah, without this, you're flying blind.
Yeah, it's also an element, I guess, of professionalization of a business. When you start out, you kind of just doing whatever you can to survive, right? But as
Yeah.
you get bigger, you need to start to put these systems in place that bigger businesses will have, and that whole time and attendance thing. It's not just nice to have. You absolutely need to have it. Some businesses not so much, yeah. But in construction in particular, we need to see where that labor component's going. It could be anything like 50%, 60% of your cogs. So we've got to know what it is. Okay, so then I think the other thing that we see often is confusion around, even just at a high level or at an in principle level. I've got all this software in my life. Why do I have it? What do I use it for? Can I just use Xero and everything's done? Can I just use Wonderbuild? So what is if we think about the different platforms in our life, maybe Dave, can you just talk us through the intention or the objective behind each of these platforms and how they kind of fit together?
Yeah, absolutely. So the most common, everyone should have a job management platform like Build Xact, Wonderbuild, Build a Trend. That's usually estimating your purchase orders. This is where you live and breathe and run your jobs. This is basically, your initial source of truth of how your jobs are going, how you're tracking all your costs, etc. It then should feed into, not duplicate. It should feed into your accounting system, which is that a Xero, a MyOb, QuickBooks, etc. You need the accounting system because it's your one source of truth. You need it for your BAS, you need it for your tax returns, you need it, to be able to do your month-end reports, because your job management system generally won't have overheads in it. Okay, won't have your rent, won't have vehicle repairs. Typically.
Can I ask a question about that? Because I have seen, we do see some people try and get a little bit tricky in their job management system and try and dial in a component overhead. Dan, I know you've seen this, and I see you smiling away there.
Yes.
What are your thoughts, Dan, on like that idea of trying to hack the system a little bit and dial in some overhead expense into our job?
Yeah, it's a really good question, Phil. I see it all the time. I mean, there's a million paths to Rome with this whole process. And it usually comes down to what you're trying to track and what you're trying to achieve. My view of having like an overhead recovery line in your job management system, I think it just creates a bit of fluff and noise. I think know your overhead load, what you're carrying, know how many jobs and starts you need based on crew size. And I'll talk about this later as well. But if you're trying to build an overhead recovery and this recovery and fat, and I think it just muddies what you're trying to measure. Because if you can measure it, then you can manage it. If you can manage it, then you can drive outcomes and performance in your business. So this overhead recovery piece, you might want to chuck it in there to sort of lower your reported margin on your contract to the client. That is one tactic, one outcome. But as far as the internal tracking goes, don't do it. I think it just adds noise and complexity. Just know your margins, know your starts, know your overhead load, and build your business. Build it as a business, not as a sneaky overhead recovery tool.
And I think, Dave, maybe it's partly because people grow comfortable with a particular platform, and so they start to want to load it with even more data and trying to get more value out of it. But it comes back, I think, to this idea that we're in SME land here, sort of small to medium businesses. Once you get to, like a $50 million business, you're going to be using something like a job pack, a full-blown ERP system.
Yep.
So in the meantime, we need to have, a number of platforms with a specific purpose around them, and then doing our best to try and have them talk to each other so that we're not double handling data. But I guess I think sometimes there's that confusion around what each of the platforms does. And really, Xero is where we want to see our overheads. And then maybe talk to the reporting layer, because ultimately it's in the reporting where all of it starts to come together. Yeah.
Yeah, and I think that's exactly right. So you capture your data in your accounting system now. You've got your month end. And Dan will talk through what a good month end looks like. Then really it's about your reporting, because it's about your feedback loop. It's about where you're winning, where you're losing. That's the most important thing. Printing out a P&L and never looking at it, it doesn't really do anything. It might be pretty, it might have lots of graphs. I mean, what I see quite often, and Dan's the same, we see people come to us and go, oh, I've got this magic month-end reports, and they don't know what it means. It's
Yeah,
lots of
look how
graphs.
good my GP is at the moment. You know,
Yeah,
I'm smashing it. Yeah.
it's lots of pretty things and all that sort of stuff. So we advocate keeping it simple, and hence what Dan's comment before. Don't put your overheads, into your job management system. Just keep it simple, keep it understandable, keep it measurable. Because then once you understand that and you understand those basics, you can then really drive the growth of your jobs through that. Now, if it's all confusing and complicating, it's really hard to do so. So really keep it simple, because ultimately we get to our reporting layer. We have our management reports, our job profitability, our work in progress, cash flows, things like that. But ultimately, all we're trying to do there is understand how our jobs are performing, so that when we circle back, if we're making a loss or we're losing some margin on that job, we know where it's coming from and how we get that job back on track. And again, more importantly, when we estimate the next job, how do we not repeat those mistakes? So for me, that's the really critical part for the reporting layer. It's not how pretty your reports are and how fat they are. I've got a 40-page report. It's simplicity and making sure you understand what it means.
Yeah, absolutely. So a couple of kind of comments and questions coming in here. There's one from Guy around labour force and actually getting your team to use time and attendance. We feel your pain. As an accounting business, we rely on time and attendance all the time, time sheeting, etc. It's part of your operational framework. And anything that you're really trying to get your team to buy into, there's a whole range of tactics you can take with that, but it has to be non-negotiable. You need to be setting the expectation from the outset when we employ people. This is how we roll. And why we're doing it. It's not so that I could check up on you or anything like that. It's so that we can make sure the work we're doing is going to be profitable at the end of the day. And if I can't see your labor hours, then I'm not going to know that, and we're going to have a shaky business. So I think that's part of the solution there, is helping explain the why. John's talking about, applying a contribution to the business budget allocated to the project, but not spent on the project. I think, Dan, if you want to field that one, because I guess there's what we're presenting to the client, but then there's how we know that the actual project is profitable, and they're kind of two different things. Yeah.
Yeah, John, it's a valid question. Again, I didn't mean my statement before to be vehement or absolute. I mean, there's a million ways to skin this. It just depends on the audience you're presenting to. If you can apply overhead load to a proposal you're giving to a client, then absolutely do it. But whether you're applying 20 grand, 50 grand, 100 grand a project, I mean, let's cut the noise. It's just more margin, right? Because you have your markup margin, then you add your overhead load. We're not going to go through and try and allocate rent to it on a fractional basis, depending on 15 jobs you have on the go. If you do want to apply and you can get away with it, do it. It is just more margin. And there's a whole art and psychological science behind how you present that to a client, squash the margin perception, etc. So I'm not saying don't do it, just be aware of what you're trying to achieve and what you're trying to track and measure in the background.
Yeah, and I think in your reporting at a margin level, job by job, you almost want to back that out so you're not distorting your actual margin position per job. Otherwise, you've got this overhead piece, maybe giving you a false sense of security around the profitability of that particular job. Job management systems, yeah, Darwin, definitely. The job management systems have a range of reporting. It ranges from really useful to not so useful. But I think this, again, back to the 3 platforms, 3 different functions. We just need to be careful about what we're using that reporting for in each of the platforms. I expect they're all over time going to try and really improve the financial reporting in each of the platforms. So that space, I'm sure, is going to change over time. But the fundamentals are that something like a Xero, we've got to lodge BASs and things like that through it. We've got to pay super. There's a lot of overhead expenses that are going to go through Xero, and it really ultimately has to be the financial source of truth. So we really ultimately want to be driving a lot of our reporting out of Xero, but then also harmonizing that with the job by job level reporting that we're getting out of our job management platforms. I guess the warning is, make sure that if you are relying on the project management software to produce your reports, make sure that they are reconciling with the right items back to Xero. Otherwise, it can be very misleading about what's happening. Okay. So ultimately, Dave, what we're trying to do here, as you said at the beginning, is job costing, and this
Correct.
idea of, trying to catch the problem early, right?
Yeah, absolutely. And this is when you got financial clarity. When you get financial clarity, this is where you're at. You understand that how your jobs are going at all times. You understand if you're winning, you're losing. Not after the job's done. We sit down and go, oh wow, we lost money on that. I thought I was going okay. So that is sort of flying blind versus I know that I lost $5,000 on that trade, but I'm going to make up $2,000 on that. So overall, we're still okay. We're tracking at our target percentage from the job. So that is what this whole process that we'll go through. And as I said, most important, Dan will talk through in the next section is on the WIP and that really that ties this all together. That really is where we get to, and that's where one of the comments before I saw was about the job costing versus the zero. Like quite often don't do the WIP calculations or do the WIP reporting and then feed that into on a job by job basis. So that's one of the challenges that you have to unpick. So, and again, Dan will talk through that in the next little section.
Yeah. Okay, cool. All right, we're going to keep moving here because we've still got a fair bit to get through. Just a quick sidebar, and I don't know if you're on Adrian Mamet, good client of ours. We're having quite a discussion at the moment around the impact of AI on the workflow in this space. And yeah, we're excited as anyone else is on this call about the opportunity that AI is going to provide. I guess what it's going to be good for is for those businesses who already have good hygiene in their processes and really understand how the accounting workflow is functioning. You're going to be able to take up some really great advancements when it comes to AI. If you're not already sorted with this, there's almost a danger that introducing automation and AI over a system that's not built out properly in the first place could again lead to some adverse outcomes, some misrepresentation around, what your position might be financially. And of course, whilst the models are, I reckon they're amazing now. I mean, they really are. Claude and the latest version of GPT are just exceptional. There's still a level of hallucination and also concern around data and data security. So we've still got a little ways to go, but I just want to flag that one because we're all hoping in this space that AI and automation will continue. We've already had a fair bit of automation in the accounting world. It's just going to accelerate now, and I think we're all going to be beneficiaries if we've got our house in order to make the most of it. So, righto, let's keep moving now. So Dan, Dave's done the work on the BK side of things, and we've got all of the data being matched up to the job. We've got that accuracy and hygiene. Now we get to this, I think, often misunderstood and overlooked function, which is the month-end close. So month-end is, well, how about you talk us through why do we do a month-end close? Why is it such a mission critical part of the overall financial clarity piece?
Yeah, really, really, really good question, Phil. And good morning, everyone. Thanks for tuning in. The philosophy behind the month-end close, maybe a bit of a silly label, but every big business I've been part of it does it. And it's really the bookend between having really good data hygiene processes and getting your data ready to convert into information and convert that information to reporting for decision making. That's the process. So we can have the best data in the world, but if we don't have the month-end close in place with the right journals and the right entries and everything else, it's still we will still struggle to produce a set of reports that sing to us and tell us what's going on in the business. So once the data's in, we want to convert that to information. That's the philosophy and the concept behind that. Why do we want to do that? Well, we want to have good information to produce good reports. If we have good reports, then we can know whether we're okay, when we're not okay. And if we're not okay, what do we do to correct the ship, which Dave will talk about. So as far as the end of month disciplines go, what we're trying to do is that we're trying to get the data and information in one place and settle the numbers at a period in time. I don't want to see, like, particularly in like an end of month pack, the invoices from 4 months or anything like that at all, because then it disrupts everything. And we start to look at I guess the monthly snapshot, the monthly result, full of noise from prior periods and late bookkeeping entries, bank accounts aren't reconciled, etc. So there is a checklist. This stuff isn't rocket science. But what we're trying to do is that, for example, if we're at the end of February, close a month, get all the invoices in. So obviously from trades and suppliers, I'm not talking about paying them, like don't rush ahead and accelerate that process. But if we have something that's due and payable, obviously get all your accounts payable stuff in. If you have open POs from prior periods, chase those up, get it into your ledger so you know exactly where you're standing. The other discipline behind this as well is that after all your data's in, please make sure your bank accounts are all reconciled up to date. Don't leave 100 grand unreconciled or 48,000. It's just going to add noise and going to create movement. And it makes getting visibility on your business, or at least getting advice on the visibility of your business, really, really, really hard to articulate. So if you have prior periods and there's poor data hygiene, I promise you this stuff will not work, especially when it comes to WIP. So obviously make sure all your bank accounts are all reconciled, including credit cards too. Like definitely don't leave those out in the ether. Chase the relevant people you need to get the invoices in, to help your bookkeeper out or your financial control function out. Don't leave it up to them. Accounts payable and receivables all up to date. Get those invoices out to clients. I know that's builders' favorite, well, builders and trades' favorite thing to do. Make sure it's right and accurate and dated well. And I guess the timing around that and the dates that drive that are really accurate. As Dave talked about before too, your payroll, make sure that is complete and up to date. Make sure that's reconciled. There's no stray transactions. All your timesheet discipline is really tight as well. Guy, just to your point before, like the formula and the blueprint to build a successful business, not just construction business, is actually really simple. The hardest thing you'll come across by far is changing behavior. And how do you change behavior? You explain the why and the purpose, and you'd be unrelenting with that discipline. So I thought I'd give you some hope there, just to circle back to your comment. The other really big piece you need to do before you start mashing out reports is just making sure that your COGS and your overhead, so your cost of goods sold. So as Dave articulated before, if you're on the hammer, on the tools, touching the job, handling the job, you can even be in the office doing a contracts administration role, obviously doing selections or PSs or PCs, whatever. They're all job costs. Make sure you get that allocation right, because if there's a stray transaction or something, it'll really upset your reporting. And obviously the other piece you need to pull in there as well is what we call prepayments and accruals in the accounting world. So all we're saying here is, for example, if you're carrying rent at 20 grand a month and you're late getting the invoice in for the month, well, accrue it. We don't want to have this big bounce around and up and down, and we don't have the clarity and I guess the direction and where we're heading. So make sure the numbers are complete and they sing to you and tell a story. And all of this whole piece here, you have to get all that squared away before you even think about starting a work in progress.
Yeah, and starting to produce any kind of meaningful reporting. So I think this is like a bit of there's that term crossing the chasm when we think about the journey of businesses going from good to great businesses, and as they scale, there are particular functions in the business and process in the business that you just have to be disciplined to get it right. There's no kind of half version of things like WIP, job costing, and your month-end close process. You have to be almost like a dog with a bone about it. As the owner of the business, you need to be really very upfront with anyone who's involved in this aspect of the business. We've got to get the invoices in. You haven't done your timesheet. I don't want to keep going on about this, but we have to have all this done, and we have to get it done in a timely fashion. Otherwise, we lose the value of capturing all of that activity in that one period. And we lose the value of having confidence that we've got it all. Because once we've done that, we can do the month-to-month comparisons, and we're setting up the foundations to be able to start looking into the future as well. So if we don't do this, then you're always going to be in this sort of state of flux and relying on what you think might be happening in terms of performance of the business and what you think might be happening with margins, etc. But we really need to have this discipline, and use that word a few times, Dan, around really capturing all of the activity that's happening in that period so that we can properly compare one month to the next and then start to look into the future. Okay, we're going to do the sidebar on WIP now. So WIP is a critical part of that month-end close. So just quickly, we do a whole webinar on this. So people want to learn about that, they can go to our website, and we've got a great WIP tool. We can send that up afterwards with the video. But just quickly talk through why WIP is so important as part of the month-end close, Dan.
Yeah, thanks, Phil. I can't stress how important WIP is, or work in progress accounting. The construction game claims are lumpy. Whether you do monthly stages or you get pushback from clients or QAs or QSs, whatever it is, the construction game is absolutely lumpy. And if you're not doing a month-end close and doing WIP, I can promise you your P&L is going to bounce around like a yo-yo, and you go, oh my God, how do I look at this and go, how do I look at this and go, am I okay? Have I got enough throughput on site? Am I generating enough COGS to drive revenue, to drive profit, to make sure I get a fair return as a shareholder? And work in progress is probably one of the most critical entries to get right, to go, am I okay? Yes or no for that month. The other beautiful thing about work in progress as well is that if you aren't doing this, I find business owners look at their cash accounts or their bank account and go, I've got money, I'm good. And then you get smashed at that BAS or smashed at that super bill and go, oh my God, I'm not so good now. But you have to get away from that and micromanage and micromeasure GP to within an inch of its life. Obviously, right size a business around overheads. Get this WIP process and right, and then you can see your profit and cash as a byproduct follows one way or another, 9 times out of 10, call it. The really, really, really important piece around work in progress is it really helps you understand how much that cash at bank is yours. How much equity are you living off in your own business, or how much of the client's money are you living off in your own business? There's a whole WIP webinar around this. We go really deep with it. There's a calculator, etc. The really important thing to figure out here with positive WIP, and this isn't a tax entry, it is absolutely a commercial accounting entry every day of the week. Don't do it at year end, 15 months after the fact when your tax return's done. Coming back to positive WIP and negative WIP. Positive WIP, the symptoms are cash is low, you've expended a tremendous amount on site, labor, materials, unfixed goods, whatever happens, whatever it is, but you haven't billed for it. That is positive WIP, which means don't worry, the cash will come. Ignore contract disputes, etc. Positive WIP, low cash, tremendous amount expended, but it's not in line with what you billed out. Don't freak out. The other way, negative WIP, I'm a bit of a fan of it if you can get away with it. It means you've brought in more of the client's money, obviously front-loaded contracts or whatever happens to be, versus what you've spent overall. I like negative WIP because more of the client's money you get in, reduce the risks, improves your working capital or cash flow, same. And you get to live off the client's money rather than your own money or leveraging debt in the business. So negative WIP means you've claimed more than what you've completed on site, including unfixed goods.
Yeah, and as we say, if anyone ever says, "Oh, you freak out because you got a negative WIP," it's just that's not the case. Either position is viable, and if you've got multiple projects running concurrently, you're more than likely going to have a different WIP position across those projects. So, hence the reporting piece and the month-end close, so that you can get a picture of that net position across the whole business when you take into account WIP across each of the projects. But as Dan said, like this WIP piece, it actually, look, the concept of WIP is really easy. Yeah.
Sure.
Yeah. Positive WIP. I've done the work, but I haven't invoiced it. Negative WIP. I've got the money, but I haven't done the work. That's it. That's WIP, right? The easy concept. It's so hard and people get really tangled up with it because if you try and calculate WIP, and you haven't done the bits that we've talked about up until this point in the webinar. So if you don't have the transactional data and you're matching it up to jobs and you've got the ability to then then you do this month-end close piece so you can close out the month, you're not going to be able to have WIP fall out of that. So it's really critical that you get that front-end piece sorted out, and then you'll be able to, trust your WIP figure. It's not something you want to, if you're in Queensland or Victoria, you're just about to get the minimum financial requirements are rolling out there soon. You don't want to have to be doing this once a year when you're doing your annual reporting. This needs to be something that you're doing on a month-to-month basis.
Just a quick question from Tim to
Yep.
Dan. Can you explain just quickly what accruals, when you talked about accruals before, accruing something, can you just quickly touch on that?
Yeah, the really simplest way of explaining is you have like monthly rent, January, February, March, April, May. You're trying to do the April close, January, February, March have a 20 grand invoice in there. April doesn't have a 20 grand invoice. You haven't got the time to chase the provider to send you the invoice, or cash might be tight, so you have to leave that go. Accrue that cost in there. We're trying to get away from this. We know you consume the economic benefit of sitting in the office. Accrue that in. Other businesses like to do what's called purchase order accruals. So sometimes you'll engage a trade or subcontractor on site to do a parcel of work. Here's your PO. You get to the end of the month. They've worked, I guess, on installing the tiles or plumb work or hydraulics on the 27th, and they're not going to send you an invoice for 2 months because they're whatever. You can do a purchase order accrual to go, well, I know that liability is due and payable. I know that's completed on site. I'm going to accrue that cost in there so I can get a bill out to a client. So basically, an accrual is plugging something that should be there. You've
Yeah.
incurred the costs, but you haven't got the invoice in. Accruals.
Yeah, yeah. Okay, so the story continues. So, right, we've got good data coming into the business. We're allocating it to the jobs properly. We're doing a really rock solid month-end close so that we can recognize all of the activity in and out, all of the financials for that particular period, all the accruals, etc. We've got a good read on what's happened for the month. Now we can start looking at a good reporting pack. So this is the bit, Dave, where we can step back out of the noise and the whirlwind of the business that we all get caught up in so much and start to look at how is my business actually traveling and where is my business going? Those two kind of distinct frames. So maybe to begin with, there's a lot of different reporting packs that you can think about when you talk about a monthly report or set of reports. From your perspective, what are the key things you'd like to see that you're looking at every month?
Yeah, for me, the most important thing, this slide here shows you the sort of what I would call a good reporting pack. So you have your profit and loss, which is actual versus budgets. That's broken down per job. You've got all your expenses recorded for your overheads correctly, your accrued, etc. You have a job by job profitability analysis for the month, for the job to date, and then more importantly, the forecast period. And Dan will cover this in a second, the forecasting piece. Your WIP schedule, which is basically tying in your cash expenses and invoicing to how the job's actually performing and are you winning or losing. That then without doing that, that makes your cash flow statement very hard to understand. So these things they will build on each other. They're not separate pieces. You have to have all these to be able to understand and get that financial clarity. You've got your AP and your AR, like you're making sure you're getting paid by your clients, making sure that you're paying your subbies, etc. And most importantly, again, is the budget forecast. Where we're going, where do we think we're going, and where we're actually going into the future. So as I said, you can't just take one of these pieces and do it in isolation. They have to be all together, and they all have to, as Dan said before, they all have to sing together to make this and sing the same story. If they're not, then we haven't got the reporting pack piece right yet, and we've got to keep working on it. And again, when we bring on a new client into the firm, they say they haven't done work in progress accounting before. It takes us a good 3 to 6 months to get this really, really, really good. And then it's just muscle memory. You just keep rolling through it from that point on. You can get to that point, but it does take a while to get that muscle memory, the discipline, the doing the timesheets, doing the month-end close cleanly, properly, timely, getting all those things in. It does take a while, but we do get into a good cadence and good rhythm. And once you're there, then that's when you really start to get that financial clarity and that growth from there.
So we're doing month-end close, depending on how well that process goes for you. You're probably then looking a week, 2 weeks out from the end of the month, depending on how your business is traveling and other things that you're trying to cater for. And then you're producing these set of reports, and then we're going on a long walk on the beach. We're sitting in a room by ourselves. I guess where I'm going here is I'm sure it would be good to. I know we offer this as a service, but it doesn't have to be us, but to have someone else in the picture to help walk through those reports with you, particularly if this is all kind of a bit foreign to you. So what's the role in this regular reporting in helping improve your financial literacy, like helping you understand what these numbers actually mean?
Yeah, you're right. Without having someone who understands these things helping you through it, they're just a lot of numbers on a page. Okay,
yeah.
and that doesn't tell you, and that doesn't give you financial clarity. It's just numbers. The most important thing is finding someone, whether it's a bookkeeper, a financial controller, a CFO, whoever it is.
Another builder, like a mentor, like
mentor, exactly. It doesn't matter who it is, but someone who understands what the numbers mean, and more importantly, how they're derived and how they can help you make better business decisions. And most importantly for us, especially in the SME market, it's all about cash flow. Is that bus coming that I can't see? Can I pay my bills when they fall due? Have I got if I got all this money in my bank account, and as Dan said before, is it really my money or is it negative WIP? Like, without all that, I can't sleep at night because I don't know what's going on. So once
Yeah.
you get that piece right, and to be fair, I can't build a house. Okay, I've got no skills at that. So, but I understand this piece for builders, and I understand for all trades how this all works. So again, it's using the right people and surrounding yourself with the right team to help you get through these things. You can't. The biggest challenge we see in Dan, I see it way too often, is people try and DIY it for way too long,
Yeah.
before they seek help and clarity. And again, it doesn't have to be us, can be anyone, but most importantly, seek that help to really understand this, particularly as you're growing and you're starting to take off and you're in more jobs, more staff, more trades, more complexity. You can spiral out of control really quickly and end up with some really large bills really quickly, and you don't even see it coming.
Yeah, I
So
think that's that that initial category of person that we're talking about where they're in survival mode. I mean, I
yep,
think if you're further down the track with this sort of stuff, I think there's a lot of value. Like, watch this back again and start to think about how you're catering for your own reporting in the business at the moment, and maybe start to think about where you want to go from here in terms of having someone else dial in to help you out with it. What you can do in terms of research online, other people in your industry that you can talk to, so like colleagues, a mentor perhaps. But it's really important that we continue to level up our financial literacy so that we can not only run good reports, but we can actually know what they mean, and help us guide decision making. And as you said, Dave, over time, once you've been doing this month in, month out, looking at the same reports, you build this
yep,
muscle memory around the ability to see what's going on in the business. You spot the exceptions really quickly. Things
yep,
stand out, like the
correct.
proverbial. And you're providing a good foundation for where you want to head and be able to start to look forward.
Yeah,
So I might
and
I
yeah,
might bring Dan back in now around the forecasting piece. So Dan, budgeting and forecasting, that's a key part of the reporting pack, but we decided to break it out as a separate topic today because of the materiality, like the impact that it can have to your emotional state, in terms of knowing what's coming down the road. So maybe just initially, there's a bit of confusion sometimes around when we say budgeting and forecasting. There's a budget, which is the budget I've got for the job, and I know it's got to land here if I'm going to make any money. There's a budget that we don't really like too much, which is this is what I did last year, plus 10%. This is what I'm going to do this year.
That's
Maybe talk through what you consider to be the gold standard in terms of what a budget is and how we build it up from the ground.
This is great, Phil. And Dave, thanks for giving me this topic because this is probably my favorite segment in the entire
I think
Prezzo.
I think you chose it, Dan, actually, just to
I had dibs, let's be honest. All
yeah,
this
cool.
all this stuff is pretty standard big business thinking. Everyone on the call, please don't think of it as like a task and a chore. We're trying to bring this stuff together and go, am I okay? Am I hitting target? Am I generating the wealth for the family that I need? So think about the purpose of what it is and not look at those 6 quadrants before and go, oh my God, this is so much work. Like this is the minimum base standard of any sort of like medium, large construction trades business to bring this together, make sure okay. So I just wanted to punctuate that. Think of the purpose while we're doing it. Am I okay? Is the future okay? Coming back to this, don't get me wrong, like the packs and all the rest are really fun. How much money have I made? But what I want to know, what I really want to know, even our own business, is how much money am I going to make? What does the future look like? If I grind and do this and follow the roadmap and the lily pad and the plan, fast forward, I get to go home to my family, wife, partner, whoever it is, and go, if we grind out this year, this is the wealth we're going to generate if we hit this plan. So the whole concept behind the budget is, as Phil mentioned before, don't go last year plus 10% and smooth it because you'll do it once, stuff in the top drawer and not believe in it and live and breathe it. Have a budget. I'll talk about forecasting shortly. Have a budget that's built on goals. And I always recommend this, especially with SME businesses or, I guess family run businesses. Split a bottle of, I don't know, a bottle of red or white or a soda pop or whatever with the better half, your family, your business partner, and go, what do I want out of this business? What do we want out of this business? And it could be time, could be dollars, could be whatever it is. Figure that out first, have that conversation first, and then you build your budget. Don't jump in and start keying numbers and this and highs. Work out what the end goal is. I want to make $1 million. That's what excites me. I only like I really want to work with clients who want to make $1 million or more. That's what excites me and gets me out of bed. What do we want out of this business? And then you build your budget and go, right, how are we going to do that? Last year, we only made 300K or 200K plus wages. What is our building blocks to get us to here? Last year, we had 3 jobs on the go. This year, we need 5, in which case we need to birth 2 crews. Or we might need a contracts administrator around May, drop that person. And what does that look like? That is a sophisticated budget, and you build the numbers around the operational plan and the strategic plan that goes, where are we going? Let's aim for something, hit for something. Because usually in my experience, if you haven't got a budget in place, and I see this a lot, and even I've been victim of this, particularly early on in my career, when I didn't appreciate it, if you aim for nothing, you hit nothing. You roll out of bed, you jump on your emails, you go to the next phone call, whatever happens to be, and goes, wow. When I was on job, I guess when I was on the job site at 5 in the morning, it's now 7:30 at night, put my kids in bed. Geez, did I inch myself forwards towards something? Or did I inch myself forwards to the next claim? Because I haven't got this framework in place and I'm just chasing the bank account balance.
So at a foundational level, so I guess what you're saying is in terms of how we build up the budget, so it's not just a business wide plus 10%. It is what I'm dialing in every single job. I'm dialing in when the cash, when the invoices are going to land, when money's coming in, when money's coming out. We're projecting that out on a timeline. Just talk through basically what a good budget looks like.
Yeah, thanks, Phil. Good reminder. So usually the easiest way to start is to build in your overheads. That's the cost of running your business, keeping the doors open. So obviously spend a little bit of time getting all that right. But for every hour you spend building that out, I'd probably spend 20 hours figuring out how you're going to land and deliver jobs. Then you jump into, so coming up to the GP level, so overheads are done, comes the GP, build in your existing jobs. So the known knowns, forecast those out, the timing of claims, when that PC date is, and build that into your budget around all that timing. And then what you want to build in there is, particularly around Q3 and Q4, once leads become dry, you have a line in there around like a sales target or a hot lead. Build those in there as well. Keep on dropping in the number of jobs that you need. So you land at a reasonable gross profit number, land at a reasonable overhead number, and get a reasonable rate of return as a shareholder. Call it net profit before tax. Aiming for around about 10 to 12%, depending on which market you sort of sit in. That's very broad, but keep on cutting this to go, am I having a good year? The other way to sort of flick it around as well is that growing is incredibly expensive every single time. So if you're dropping in a new site super, promoting someone, bringing on a BDM, if you're a really big business, like the payback on that investment is tremendous. So understand how the business goes, take away a look at it and go, does it make sense? Am I comfortable with the money I'm going to make this year? Am I comfortable with the risk profile that I'm taking on board? That is a good budget.
Yeah. And then once we're doing that, and we've got this discipline of each month we're looking at it, we're updating our dynamic forecast as soon as things happen. So as soon as we win a job, we're going to get in there and map out how that revenue is going to flow, how the costs are going to flow. As soon as we lose a staff member or gain a staff member, we're always continually kind of updating the budget so we know where we're going. But we're also, though, having this opportunity monthly to step back and look at it and then look into the future. And it's going to be able to tell us that in 6 months' time, we've got a real problem. We've got a job that's finishing. We've got, three jobs starting, 3 months later, but we're going to have a gap, if I drop in an estimator or a PM or one of these key growth roles, what's the impact going to be to my budget and my bottom line? So you can either do that, by kind of gut feel and emotion and hoping and maybe looking at past performance, like you can say, this is what I've done so far, and I think that means I'm going to go here. Or we can just dial in all the facts that we know as they stand. I think also, we do a process that we call the bow wave, which also starts to dial in our pipeline as well. So we start to look at, any of the really, strongly confirmed, projects that we're costing and we're estimating at the moment that we've got a pretty good handle on that are going to close. we dial in pipeline as well so that we can start to really look at the future, not as something that's fuzzy that we can't plan around, but something that is a much higher degree of certainty than if we weren't doing this process. So we've kind of, I think we've spent a bit of time on this because we really think that this is one of the real keys to financial clarity, is being able to really see what's coming down the pipe. And again, though, there's some work that you've got to do to kind of build the discipline in place. Okay, so without a loaded budget, you're going to make decisions based on what's in the bank today. So we don't want to make any decision based on what we can see in terms of cash at hand, cash in the bank. It is just a false economy and a false scoreboard. We want to use our budget to make better decisions. Okay, so I'm going to run a poll here because I'm interested in terms of what you think your which one is it here? This cash flow horizon. I kind of like the cash flow one because it's a little bit of an indicator as to how well we're budgeting, how well we're running our reporting, how far ahead. So when I look at cash available in the business today, I can see this covering what? I can see a week ahead, I can see 2 to 4 weeks ahead, 1 to 3 months, or 3+ months with high confidence. Be honest, people, you are just answering yourself here. So let us know what that cash horizon looks like. Okay. Yes, and as you'd expect, actually, I think this is really good, guys. I think we've got quite a few people who are in a position where they're able to see 1 to 3 months ahead, which is excellent.
Good, very good.
That is brilliant. And I think this is symptomatic of people, really more and more in the industry, we're seeing people level up through a range of different services so they can understand what's happening in the business in a better way. Okay, we're going to push on. The final bit here is resourcing your capability. So very quickly, Dave, because we're almost out of time, we've got these different roles when it comes to transactional. So we're looking for a bookkeeper and a specialist bookkeeper in that space. What about the month-end process? Like, what sort of role is that? What are we looking at to build out our capability around in that particular function?
Yeah, we've only got a couple minutes left, so I'll go through this quickly.
Yeah.
Basically, everyone needs a good bookkeeper, someone who can capture the data, whether you do it internally or you outsource that, that's fine. But it has to be, the only thing I would make sure they have to understand construction. Okay, they have to understand how the construction industry works. Otherwise, it just won't work. We just see it so often, it's bad. So then you get your data capture in there, and then you need your month-end report. So you need someone who's got a higher level of understanding than a bookkeeper generally, in terms of accounting, to understand cash flows, to understand WIP, do job reports, etc. So
and they're going to do all the journals and make
correct.
sure that the accounting, your accounting system of record is accurate at the month-end close. Yeah.
Yeah, correct. So they will do that, and the most important part in that section for me is the work in progress that Dan talked about before, getting that part right. That's the critical bit.
Yeah.
And then if you look at the advice, and then if you're a bigger business, you're going to need some a CFO, either in-house or a partial CFO, to help you with your reporting, your budgeting, your forecasting, your reviewing, and your pipeline and things like that. So as you grow bigger, naturally you need more resources to help you keep growing the business. And
I think this, you can almost break this out at turnover size. Once you get over 1 or 2 mil, you're going to need a good bookkeeper who knows the industry, knows all the job management software. Once you get to sort of approaching the 3 to 5, you're going to need a financial controller of some sort. So like an internal accountant, part-time. It's hard to find, but you need that kind of someone who's actually got financial control as their skill set. And then once you get to that 5 mil plus, 10 mil plus, you need to really have someone who's going to help you not just in the finance function, but more broadly across the business as well, and who has the experience in big business. So to help you get to that, crossing the chasm bit. There's a few questions around rates. We thought that might come up. So this is market rate in terms of what we think is in the market. You've got 2 options really, or a hybrid of the 2 options. So you can either hire in, and we've just shown this as a monthly fee. So you can have a specialist bookkeeper in that kind of price range, a financial controller in that price range, 12 to 20, or a CFO in that kind of price range. So we know this because we hire these people all the time. So we know what market rate is for someone who has building and construction experience. You can do that as an internal hire, or you could go to a firm like us who does it as a fractional service. So you're really paying, more like a part-time external service to come in and fulfill those roles. So as you can see, no surprise, because it's fractional, it's considerably cheaper to do it that way. And of course, it's a tax-deductible expense, and you don't have all the headaches and on costs of having an employee. It's an outsourced fractional service. When it comes to the way we deliver this, I hate saying outsourced, because I know, Dan and Dave, you don't feel like you're outsourced at all with the clients you look after. You're right in there, right in the guts of those businesses helping out. But it is the term that generally we use alongside a fractional service. So then you might want to, as you're starting out, you might get a specialist bookkeeper to begin with, and then you might go and hire one, but you might then need to bring in a fractional FC or a fractional CFO over your internal team. That's a viable kind of hybrid option. And I guess I would just say this changes all the time as you grow. Your needs will change as you grow. So you need to really be looking at how you build out the finance function. And this is, I guess, just a way to do that. Drop into the chat if you'd like to find out anything more about those services that we've offered, which is financial control, bookkeeping, or CFO advisory. So that's CFO component. And we'll be sending out, obviously we're going to be sending out a email afterwards, so that we'll offer that as well in the email. Click the button for either of these. So I'd like a free consultation to learn more about outsourcing my bookkeeping to an industry specialist, engaging a fractional FC controller, or engaging a fractional CFO. We get quite a lot of a response to these, so it might take us just a couple of days to get back to you, but please lock that in. We've got your details from when you registered for this session, so please check those details. If they're not correct, let us know. Just while that's happening, I will just quickly mention we've got a couple of other events coming up. So I said we've got the same, this financial clarity session that we've done as a webinar today. We've got that coming out as an in-person session. So we'll be sending information about that. It's a bit over half a day, and we're going to be able to do a much deeper dive. And it's a small format, around 40 people for that. So we'll be able to actually talk through the specifics of how you connect up your systems. We'll actually look at a reporting pack. We'll talk through what accruals and journals are, all those sorts of things, so that you can learn more about that. We also offer this strategic planning workshop. It happens over 3 months, a half day each month over 3 months, where you build out your strategic plan for the business. 10 years, 3 years, 1 year, what's happening over the next 3 months. And then we partner with you over that 3-month period to help you build that out. It's not generic, it's specific to your actual business. You will have, at the end of that process, a really strong strategic plan for how you're going to grow. And then finally, I'm sorry to end on this, but Payday Super is coming, and it's going to have a really big impact on your cash flow. For some more than others, no doubt, but you're going to have to start paying super. And in this industry, a lot of the time, payroll happens every week. So you're not going to have that sort of 3-month buffer anymore. So it's not a complex thing in terms of the way the payroll is going to work and super is going to work in Xero, etc. But it is a cash flow concern. So we need to get on top of it. So we're going to run a webinar. We'll send all the details out so you can register for that one as well. Okay, I think I'm almost out of breath. Thank you very much. We're over time now, so we better go so everyone can get back to their busy lives. We do hope to see you soon. Please come back to us with any questions at all. There's a survey at the end, so please complete that survey for us so we can help improve these sessions for everyone. Thanks, Dan. Thanks, Dave.
Thank you.
We'll see you all sometime soon. Bye-bye.
Thanks, guys.
Bye.
See ya.